Singapore is accelerating collaborative contracting in 2026 after BCA launched Asia's first NEC4 facilities management pilot. To explore the shift, we have Ada Choi of CBRE and Sigrid Gelsita of APREA. Ada and Sigrid, thanks for joining us. What is driving the rebound in APAC real estate investment volumes?
Yes, I think for the first quarter of the year, we've already recorded about 18% increase of the investment volume across the whole Asia-Pacific market. The strongest growth market is, in fact, Singapore, with over 170% growth quarter on quarter. It's largely because of the large transaction done by Hongkong Land for the new funds being formed in the market. Besides that, we also see that the Indian market and Japan have a strong growth in the first quarter because of the strong interest of the investors continue to put the capitals in Japan, which is the largest market. While for India, many of the investors are looking for the growth. On top of that, one of the major reasons for such a recovery is that we had several years of downward cycle of the interest rate, so the borrowing rate is much lower, and therefore many of the markets can provide the positive spread to the borrowing rates when they invest in real estate.
Thank you so much for having me, Pablo. So what we're seeing in terms of the rebound in Asia Pacific, it's being driven by greater pricing clarity, as well as I would say focus on the cash flows. However, it's not a broad-based recovery that we're seeing. Looking at the sector performance, you see indicated here is that office is being emerged as the most preferred sector. And the reason being is that leasing activity is returning and there's a flight to quality trend that's fueling that. So what we're seeing is that high quality buildings in core locations is driving a bifurcation in investment assets. Liquidity is also deeper this time around, more diversified. Cross-border capital flows are actually at record levels. We're seeing a lot of domestic institutions and REITs also being consistent buyers this time around. We do expect this to be continuing at least for the balance of the year.
Why are cap rates diverging so sharply across key markets?
So for the cap rates, is you have mentioned this diverging, because the interest rate movement is now more diverged, and also the market situation across the Asia Pacific is becoming a bit different. So I think one thing we note is the change of the market situation in Australia. Australia is now having a much higher interest rate environment, and also the inflation environment is also quite tight. As a result, I think Australia, which has cut interest rate last time, already add back the interest rates this year thus far, and we are still expecting more rate hike within this year. As a result, I think previously the market was expecting yield compression, but now the market is underwriting some mild yield expansion in Australia. But this is on the back of the rental growth and also some of the low vacancy in the market. So it is canceling out the impact. I think another market I want to highlight is Japan. Japan has been having this yield compression in the past few years, given that their interest rate is so low, and I've also mentioned that many of the investors like Japan. But now Japan has entered into the rate hike cycle, although at this moment we saw that a Bank of Japan is very reserved of increasing interest rate. Markets still expect 2 rate hike, but it is possible to have one more rate hike. But nonetheless, we are seeing that for the real estate pricing, particularly measured by the cap rate, is not compressing anymore.
Right. So the cap rate divergence is actually due to the differences in financing conditions, the recovery stages in markets, and also the supply outlook interacting across these markets. Cap rate movements are actually localized rather than being influenced or driven by a single regional trend. And one example of this is actually Japan. It has been a long, for quite some time, it has been a low rate in this environment. And what we've seen is that monetary authorities are now changing their policy, and it's all going to be on a path of gradual policy normalization. So with an upward pressure on the rates, we can expect cap rate compression to be limited this time around. Investors in Japan are therefore shifting their strategy from yield expansion to income stability, recognizing, of course, that returns will be driven by rent rather than pricing. Now, at the global level, the Middle East conflict is actually influencing the interest rate expectation, and we're seeing that in inflation and the bond yield. So, and you're expecting this, by the way, to be trending higher as the whole conflict actually remains unresolved. Now, what this means in terms of the divergence, we can expect a cap rate of upward pressure on cap rates, particularly in more interest rate sensitive markets like Australia. In supply constrained markets with strong rental prospects, we could expect cap rates to remain stable despite higher financing costs.
And how should investors evaluate differing risk-return profiles across APAC markets?
The elephant in the room is always the Middle East conflict and also the high oil price, which is leading to quite a lot of concern about the interest rate movement. That many of the forecasting, the view has already been changed during the past few months. At this moment, the dynamics of the market is turning more on the fundamentals of the market, less concerned about the interest rate. Many of the investors have already revised their view on the interest rate and also the inflation, particularly we've mentioned about Australia. It is time to look at the assets itself and evaluate based on the market's demand and also the rental growth profile. I think one impact that we are seeing from the high oil price, in fact, is the high construction cost as well. As a result, we see that it is going to be even more difficult to bring in new office or new retail projects in the market. So this is something that landlords and investors have to note. If they are thinking about investing, they are also thinking about where are the areas that the supply-demand dynamics is going to be squeezed even more. And as a result, in fact, I take office as an example. Also, mainland China, all the markets are still experiencing the rental growth situation, which is something that investors are more concerned about, which is the income profile.
So investors need to move away from headline indicators. They have to be more granular in assessing their investments. Returns will, as I mentioned a while ago, will be driven by rental growth and asset management rather than price gains. We all know that we have different dynamics across the region, and investors need to have a strategy for stability and growth. Exposure to markets such as India, Southeast Asia, particularly those that have strong trade, supply chain related assets, they will have a higher upside. I do want to mention that the development pipelines today are also shrinking across Asia Pacific. And that is because of high construction costs and financing constraints. So that means that high quality assets will be increasingly constrained, at least in the near future.
Sigrid and Ada, thanks very much for sharing your thoughts with us.
Thank you so much.
Again, those were Ada Choi, Head of Research in APAC at CBRE, and Sigrid Jalsita, CEO of the Asia Pacific Real Assets Association, or APREA. For more news, visit realestateasia.com.